Equity line of credit on commercial property. Get commercial equity lines today. Acquiring funding for your business is a must. However, traditional loans may not cover commercial property costs. Enter equity lines of credit. They allow you to utilize the equity in your commercial property to fund business requirements. The Federal Reserve reports that banks lend over $2.5 trillion to commercial and industrial loans as businesses seek financial support. This is why equity lines of credit have become popular among entrepreneurs who require financing for expansion. But what exactly are they, and how can they impact business growth? Let's dive into the details of equity lines of credit on commercial properties and their advantages for your enterprise. So buckle up, and let's dive in. Equity line of credit overview. An equity line of credit, also known as a HELOC, is a loan type designed to provide business owners with access to funds by allowing them to borrow against the value of their commercial real estate. This type of loan is typically used for business expansion projects such as capital investments and renovations. Unlike traditional loans, interest rates associated with HELOCs are usually lower. Lenders view this type of loan as less risky since they have collateral if the borrower defaults on repaying the loan. Commercial equity lines of credit tend to offer more flexible terms than traditional bank loans. Some lenders allow borrowers to withdraw specific amounts at certain times, while others may permit only interest repayments in the initial years before beginning principal payments. The flexibility of equity lines of credit makes them an attractive option for business owners looking for funding. They can be tailored to meet specific needs or change over time due to changing market conditions or customer demand. Advantages of using an equity line of credit. One of the attractive financing options for entrepreneurs and businesses looking to access capital is using an equity line of credit on commercial property. By using this option, various benefits are available. Securing funds at lower rates than traditional lenders is one such benefit. With the value of a commercial property used as collateral, borrowers can rest assured that they will have access to sufficient funds at a reasonably low interest rate. Also, this type of loan allows repayment in whole or part throughout a set period. This gives borrowers more control over how much debt they take on and adjustments in borrowing based on changes in market conditions or cash flow needs. Eligibility criteria for an equity line of credit. Specific qualification requirements and eligibility criteria must be met if you're looking to finance a commercial property using an equity line of credit. Your business credit score should be above 680 to qualify for the best lines of credit available. Lenders will also look at the size and history of your business and any existing debt obligations or liens on the commercial property. They'll also consider other financial information related to your company, such as cash flow, revenue projections, and income statements. Regarding commercial equity financing, lenders usually require a minimum down payment of 20 to 30%. If you want to purchase a $500,000 property with an equity loan, you'd need to make a down payment between $100,000 minus $150 upfront before being approved. Depending on the lender's terms and conditions, you may also have additional closing costs or fees associated with obtaining the loan. These eligibility requirements can vary from one lender to another, so research is essential when applying for a commercial property equity line of credit. Ensure you understand all the qualifications and paperwork before committing to any financing agreement. Qualification and credit ratings, how they're connected. When looking to get approved for equity lines of credit on commercial property, a few factors are quite as crucial as your credit score. Why? Because a good credit score indicates that you're a responsible borrower, making it more likely that lenders will be willing to offer you better terms and higher lines of credit. If your credit score is poor or only average, however, lenders may not be willing to provide you with a loan. After all, the better your credit is, the more money you can borrow, and having excellent business credit cards can help increase the amount even further. Building up your line of credit over time by using them responsibly helps demonstrate to prospective lenders that you're an ideal customer who pays their debts on time. The diversity provided by having multiple types of business and personal credit cards also adds credibility to your overall portfolio, boosting your chances of approval for any subsequent loans or lines of equity. Understanding how your financial situation affects this possibility requires evaluating the state of your credit ratings, how they could potentially impact future financing opportunities, and recognizing other options available in case lower scores result in ineligibility for larger sums through these programs. To increase chances at installation success rates with optimal terms and amounts from lenders when applying for those types of finances that require several discerning criteria such as rules around transfer pricing arrangements or ratios like DSCR, debt service coverage ratio, understanding one's current financial ability is often monumental. Types of loans available. Now that we have discussed how credit ratings play a role in qualification, let's explore the different types of loans available for commercial property equity lines of credit. Real estate loans are a popular option for purchasing or refinancing an investment property. Whether you're looking for financing on residential real estate or commercial space, there are loan options to fit your needs. Regarding commercial properties, some lenders offer secured and unsecured lines of credit with variable rates depending on the financed asset type. Secured lines of credit are backed by collateral such as inventory or machinery and may require additional documentation to qualify. Unsecured lines of credit don't need any collateral but come with higher interest rates than those offered with secured loans. Depending on your financial goals and risk tolerance, either option could suit your situation. No matter what type of loan is right for you, it's essential to research beforehand to make informed decisions about which best fits your needs before committing to a loan agreement. Be sure to compare offers from multiple lenders and get advice from experts if necessary. This will ensure that you find the most advantageous terms possible while protecting yourself financially in the long run. Necessary documentation for the application process. Certain documents must be included in the application process when applying for a commercial property equity line of credit. The loan type will determine what documentation requirements you need to provide, and it's important to carefully review all paperwork before submitting your application. Real estate financing typically requires standard documents, such as tax returns, bank statements, and financial records. Depending on the loan terms, you may also have to submit proof of income or other collateral forms. Some lenders may require additional information or updated documents throughout the transaction, and knowing what is needed can help make the process go more smoothly. With proper documentation, you should be able to access funds quickly while keeping closing costs low. To ensure this happens, working with an experienced lender who knows precisely what documentation is needed for equity lines of credit on commercial properties is best. With their expertise and guidance, you'll soon have access to capital without any unexpected delays. Call 888-653-0124 today or click the link in the description to learn more.